Good morning, everyone. Tim Nyland here. Today is Wednesday, December 16th, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market, interesting trends, and investing opportunities. If you have a topic you'd like me to explore in a future video, please leave a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of Zacks Pro platforms. Please do not forget to hit the subscribe button below to make sure that you never miss any of our future calls. Today, we're going to resume our hyper growth strategy series that we started on December 2nd, and I'm going to illustrate the importance of establishing an analytical framework with reference points in terms of other like stage companies when comparing the valuation and fundamental characteristics of hyper growth companies. In the spirit of full disclosure, I do not currently have a position in either SFIX or Freshpet. I would like to remind everyone that hypergrowth investing is very speculative in nature and is not suitable for all investors. I am not here to pitch SFIX or Freshpet as a buy or sell. Rather, I'm here to simply help identify analytical issues of relevance you should consider, and from here you'll need to draw your own conclusions regarding any buy or sell decisions. So let's get started. Last week, I was approached by no less than 3 financial advisors about what I thought regarding SFIX. And you'll see up on the screen right now, I've got the infamous Zacks Research System price and earnings chart up on the screen. And by now, this is our 3rd hyper growth series webinar. Hopefully, everyone is starting to see a trend with these hyper growth stocks. So the trend when you're looking at price and earnings on a screen that is properly scaled is you'll see either earnings go from positive to negative, and then you'll just see this really parabolic growth rate in terms of growth for 2023. We see that to the tune of 527% here. Or you'll see that earnings have just been negative literally since day one of the company going public, and then all of a sudden they just burst out and they break positive and just an astronomical growth rate. So SFIX, as of recently, has become a candidate for potential hyper growth. And on, I believe it was Monday of last week, that would have been around December 7th, SFIX reported a surprise profit for the current quarter. And what really got everybody buzzing was the revenue growth guidance from 20 to 25% range for the following year. And on December 8th, the stock literally surged 40% on that news. And so the CEO attributed the surprising quarter results to a surge in new active clients, greater customer satisfaction, strong back-to-school season, and obviously more affordably priced clothing has been one of their initiatives. My wife has actually ordered from SFIX in the past and likes it. But when we talk about these types of companies in terms of an investment, the very first thing I want everybody to see is this rapid rise in price, and yet we're still not going to be breaking even in terms of earnings until 2023. And keep in mind that SFIX is not only a clothing manufacturer, but is obviously exposed to all of the issues related to fashion, tastes, and all that. So we'll talk about all of this here in just a minute. Okay. So again, highlighting the red flag that first caught my eye when I looked at this stock. I had several advisors bring this to my attention, wanted my opinion, and I said, you know what, give me a little bit to do the research on it, do the analysis, and let me get back to you. And so this is what I saw. And I see that this guidance from 20 to 25% in forecast revenue growth that management gave is not going to yield annual profitability again until 2023. So the first thing that comes to my mind as a portfolio manager is I need to look at this cost structure. I need to look at these margins because we've got something potentially going on with margins. And so the first thing I did is I just took a look at the balance sheet just to see how it looked. And the first thing I notice is that there's no debt on the balance sheet, which is good. The bad news is that margins are negative and appear to be strained and under pressure, right? So gross margins appear to be okay. Then we get down to operating margin, negative 2.6, EBIT margins 4.1 negative pre-tax, and then obviously a net margin of negative 3.3. Okay. Profitability metrics are also negative, so they're obviously still consuming capital. Okay, this is more news that is probably not the best news. When I'm looking at hyper growth companies that have risen rapidly, I'd like to see more of a turn in these types of numbers, and I'm more approaching this from the perspective of, hey, in the back of my mind, I know another company that's in a similar phase of growth that has maybe some better profitability metrics, maybe some better margin numbers, and that company is Freshpet, which is what we're going to talk about here in just a minute. So in the back of your mind, it's very important as you're going through and analyzing these hyper growth stocks to have these analytical points of reference with other growth companies. Because when we're analyzing growth stocks, you're always looking for a place to start the analysis. It's kind of like when you first break that brand new puzzle out of the box. Everybody tends to build that border first, right? That's an analytical framework. You always build the border first, and you start filling in the rest of the puzzle. And that's what you're doing with hyper growth stocks. You're looking for some area to begin your analysis. With Stitch Fix, it was very easy. We saw that gap between that really rapid increase in price and the fact that they weren't going to be profitable for quite a period of time until 2023. So when we looked at that balance sheet and we saw that there was no debt, the very first thing that comes to my mind is that they've probably got to be issuing stock if they're continuing to consume capital, right? So negative profitability metrics, those types of things, that's consumption of capital. Then they've got to be raising capital somewhere. And so they are forecast to continue to issue stock, and this is obviously dilutive to common shareholders. So again, not the best of news, just something to be aware of. The real story is when we look at the Zacks Research System growth and margin check. And you can see that we've actually got forecast forward 4-quarter revenue growth, and you can see I have it highlighted right here, at 26%. So management guided between 20 and 25%. I waited about a week and a half after the company reported, so the analysts have gone in and revised their forecasts here for the next 4 quarters. And the analysts on the sell side in aggregate, right, we're not using the diluted numbers, we're using the aggregate revenue growth, so not per share, not earnings per share, but actual earnings. We're comparing that 26% forecast revenue growth is only going to yield 19% EPS growth. So that can only happen if you have negative margins, right? So you're not growing revenues or you're not growing earnings as fast as revenues. So traditionally what you see in these hyper growth companies is you see the earnings, take off double, triple digits at 20, 30, 40, 50, or even more % growth. But it's very common to see earnings grow at a much faster rate than revenues. And that's when you start really ramping up the net margin efficiencies. And like I've always said, when you can catch these companies as they're turning their net margins, the earnings per share growth can absolutely explode. So again, in the back of my mind, as I'm going through the analysis of Stitch Fix, and there's all this buzz on the street about Stitch Fix being the next hyper growth company, and the fact that Abercrombie is closing down a bunch of stores. You've got a bunch of other, obviously, brick and mortar retailers shutting down, stores that Stitch Fix is going to capitalize on all this. Yeah, I'm still thinking in the back of my mind, I know another company who's been growing net margins at a lot faster clip, who's growing revenues about the same rate, but is producing triple-digit earnings growth. So again, going back to the importance of building that analytical framework, make sure that you're looking at enough of these hyper growth companies to where when you finally decide to make an investment, it's an informed decision. You're looking at it relative to pricing and valuation of other companies, not just solely focusing on this and saying, oh, this looks great. Because I can tell you that there are companies out there like Freshpet that are growing at a much faster clip, that are at the similar stage of growth. Okay. So here is the result of the margin pressures. Now, I want everyone to focus on this chart. It's a great chart. This is one of the charts we're going to be bringing into Advisor Tools shortly. Again, this is the Zacks research system, and this is the Q1 actual consensus EPS estimate revision chart. And I want everybody to focus on the dates, okay? Remember that management reported right about here, so it was around December 7th. The stock shot up December 8th, and then we had analysts revise their estimates, and we actually got a negative revision. So estimates have already rolled over since they reported last week. And again, these are those margin pressures surfacing again. Okay, so this is probably not what you'd want to see in a stock that just shot up 40% and you're looking for that next hyper growth opportunity. So the idea is, we're playing detective here. And so the very first chart gave us a sense that there might have been a margin issue. And as we start peeling back the layers of this onion, we're finding that in fact, now we've got real evidence here. And in fact, we've got the underlying Q1 and Q2 EPS estimate revisions rolling over negative. Not only are they rolling over as a negative revision, we've gone from being positive to actually negative in that January quarter. Okay. So Stitch Fix is not only benefiting organically from changes taking place within the organization, but benefiting from the closure of many brick and mortar retail locations, including Abercrombie. Ascena Retail is another big one. I think that's Lang Bryant and Kashyyyk and a couple other store groups that they're shutting down. But the idea here, and this is a really, really important point that we're going to carry into our analysis of Freshpet, is this second bullet point. So even if the appeal to online clothing is sticky for Stitch Fix and they can retain a large portion of their customers, and I want to reemphasize this next portion of the sentence. Demand for clothing and fashion is very elastic. Okay, think of a rubber band, elastic regarding taste, trends, and price. If you come in above trend, below trend, just enough, the rubber band snaps and you have no demand. It's elastic. You've stretched the rubber band. Okay, this is elasticity of demand. Okay, this is going to be an ongoing margin strain for Stitch Fix, as it is for virtually everyone in the fashion industry. Just be aware of that, because when we look at Freshpet, we're going to be looking at something that is very demand inelastic. So the idea is Freshpet being a fresh, healthy pet food alternative. The idea is consumers will literally spend any amount of money on their pets as they do their children and their cell phone bills. And the other thing is that once you change a pet's dog food and they like it, you know that look that your dog's going to give you if you go to change them to some cheaper dog food. Not only that, it makes their stomach upset and everything else. So it's a much more inelastic demand that Freshpet has. So again, when analyzing any stock or attempting to do your own original research, you must always have a framework and an analytical reference point that you can look at in terms of context for valuation and fundamentals. And I chose Stitch Fix because there was so much buzz around Stitch Fix, and I had advisors asking me about it. And I also chose Stitch Fix because it was a great way to have a little bit more fun than the serious nature of what's going on with Tesla and Mercado Libre. We could relax a little bit and show a very simple case of why this matters in looking at a clothing company versus a pet food company. And so I think you're really going to enjoy this next portion of the analysis as we turn the page to Freshpet. And immediately you'll see something that looks a lot different. And again, I'm pointing out here, are you seeing a trend in these hyper-growth companies? Again, Freshpet being negative earnings the whole time, just popping positive in 2020, but you're going to see something very different with Freshpet, right? It never had that parabolic upshoot 2 years ahead of being profitable that Stitch Fix had. This Freshpet has just been a steady rock in terms of price appreciation. And the other thing I want to point out is that we just turned profitability in 2020. We posted almost 300% growth in FY1, and we're looking at 428% growth in FY2 and 80% growth in FY3. And this points back to that whole concept of we've now got a company that has net margin growth expansion that's material enough to produce this type of what I call parabolic earnings growth against a backdrop of what I suspect is and has been some pretty solid and sustainable revenue growth. So just by looking at this one price earnings screen as a portfolio manager and as an analyst, I'm able to come to those types of conclusions, at least enough to point me in the right direction to where I need to start focusing my analysis. Okay. And in fact, this particular screen outlines exactly what I just said, right? EPS growth 290, EPS growth for FY2 428. Looks like there's a little bit of a typo in my slide. This should actually say FY2, and keep in mind that anyone can request access to my slide deck. I will obviously fix this, should say FY2, but my slide decks are available to anyone who requests a copy. EPS FY3 growth of 80%. I've highlighted the relevant areas down here. So this is telling me that I've got a really nice hyper growth company that has some really, really nice margin expansion going on. Now I want to take a look at what's going on perhaps with revenues. Now that I'm looking at this as perhaps an alternative to Stitch Fix, I want to also take a look at the balance sheet and how they've been funding their expansion. And also just like Stitch Fix, Freshpet has no debt. So this is a really good comparable. The other thing that I love, and we talked about this with Mercado Libre, is that Freshpet only has 42 million shares outstanding. And we've also got share issuance that's forecast to subside by June of 2021. And keep in mind that when we look at Stitch Fix, it's forecast to have 112 million shares outstanding. So we've got a company in Freshpet that's going to be far less dilutive, which means for common equity shareholders that are demanding more exposure to Freshpet in terms of purchasing outstanding shares, we could see some really, really good price action to the upside on Freshpet. And that's what we've been seeing steadily for years. Okay. I've highlighted that here. You can see that 42 million shares outstanding. Big share issuance funding that last stage of growth, and then it subsides in June 21. That's what I like to see. The other thing I love to see relative to a Stitch Fix, keep in mind Stitch Fix's margins were negative. They were improving slightly, but the forecast 4 quarters were still negative 2.1%. And keep in mind that's after the revision on management's guidance up from revenue growth 20 to 25% over the course of the next year. Analysts have already revised. I waited 10 days to pull these charts. And so what I want everyone to see, again, with Freshpet being that similar hyper growth stage as Stitch Fix, I've got a company that's already gotten to positive net margins, right? And not only are they growing net margin, they're growing net margin substantially. Going from a 1.6 to a 6.0 is absolutely tremendous. If you don't believe me, take a look at the difference in margins between a Walmart, a Costco, and an Amazon, and tell me that margins don't matter. They do. Going from a 1.6 to a 6.0 is huge, and you can see exactly what that looks like in terms of earnings growth. You're going at a steady 29 trailing 12-month top line revenue growth, and you're sustaining that. You're only going up 1% to 30 over the forecast 4, but take a look at what you're doing in terms of earnings growth. You're going from 213% growth to 423% growth. And keep in mind, Freshpet has been steadily growing revenues over the 10-year lease squares rate at 27%. You can see 31 over the latest year. So you've got, from a lease squares perspective, revenue growth steady at 27 to 30%. That's just something that you don't see with Stitch Fix. They're just now guiding to 25 to 30. Well, here I've got a company that's been doing that for 10 years, and I've got margins expanding from 1.6 to 6.0 versus still being stuck at negative 2.1 like Stitch Fix. Hopefully you're starting to see the trend here, okay? Now, the big issue, for those of you that have listened to me on my earnings certain portfolio calls and know how I like to pick stocks, I like companies that are compounding capital in a positive manner for common equity shareholders. And once we get profitability metrics turning positive, it's got my attention, right? So when we're talking hyper growth, you can see this, negative compounding of equity, 2015, 2016, 2017, all these metrics are negative. These are our profitability metrics, okay? So the idea is they're basically consuming capital. Now we're getting positive. Now it's got my attention. Okay, this is really good. So the analytical issues of relevance I want to highlight here is that Freshpet has had this sustainable revenue growth between 25 and 30% on a lease squares basis for 10 years now. They became profitable in 2020. Margins are growing tremendously. It's yielding just astronomical rates of annual EPS growth. And this is really what you want to see in a hyper growth company. I mentioned this before when we were talking about Stitch Fix, but the demand for pet supplies, specifically food, is virtually inelastic. There's literally no limit to what individuals will spend on their pets. I mean, consumers love pampering their pets. And I also added in here, cell phone bills and children as well. When times get tough, right, the children are still going to get clothed, fed. You're still going to pay your cell phone bill. In fact, most people will pay their cell phone bill even before they pay their mortgage. So you've really got to look at these consumer tastes. There's a big difference between pet supplies and fashion, specifically clothing manufacturing. So the key takeaway here is, obviously, when analyzing any stock or attempting to do your own original research, that's what we're doing here, right? You've got to have this analytical framework and these reference points that you can look for in terms of valuations and fundamentals. And anyone who's ever been on a strategy call with me knows I've always got a myriad of companies in my back pocket that I can pull out at any time. When somebody asks me about a stock, I've got 3 or 4 companies I'm already thinking of in the back of my head that are either in worse shape, comparable shape, or better off in that sector, in that industry, or as a better investment alternative. So the idea is, don't ever jump into a hyper growth stock without having this context in mind, because these things can turn on you and come back down just as fast as they go up. I'm not saying that's what's going to happen with Stitch Fix. I think they've got a solid road ahead of them. I think they are going to be able to retain a lot of that brick and mortar business that they're taking right now. But as an alternative, I like what's going on at Freshpet, and I would just encourage everyone to dig deep and come to your own conclusions. So that's about it for this week. I hope you found this video helpful. Again, it's not the specifics of Stitch Fix and Freshpet that are important. What I want everybody to walk away with is again, the importance of having those analytical reference points when you're looking at hypergrowth stocks. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. Thank you for watching, and I hope to see you next Wednesday for another weekly strategy call. And I'll go ahead and put this last slide up on the screen. If you've got questions, here's the email. And you can either email to advisortools@zacks.com or zrs@zacks.com. Give us a call. You can also reach out to me directly. Follow me on LinkedIn again. Follow me on Twitter. And we'll talk to you next week. Thank you very much.